Well, I was born in Ukraine. This is my home country. And despite the fact that I live in Austin, Texas, my heart is still with Ukraine. When Russian tanks roll into Ukraine on February 24th, beginning the largest land war in Europe since Germany invaded France in May 1914, they also sent a shock waves through the markets. And what happened next, only God knows. But we know one thing, the history is cyclical. So if you want to predict what happened in the future, we should look back and analyze how crises affected the market in the past. What was the effect on stocks of more than 50 crisis events starting from the panic of 1907 to the COVID-19 crash of 2020? You will be shocked, but the pattern is the same every time. For instance, in 2020, after falling an average of 7% in the immediate aftermath of the crisis, the Dow rose 4.2% over the next 3 weeks. 9 weeks later, it had gained 6%, and after 18 weeks, it was about 10% up. So not every event followed this pattern precisely, and all were the subject to large economic forces. Yet the study shows a remarkable symmetry in the market reaction. Germany's invasion of France 82 years ago didn't come as a surprise. A state of war had existed since Germany's invasion of Poland the previous years, but it still sent stocks rallying. The Dow dropped 17% in the immediate aftermath and dipped another about 1% over the next 3 weeks. But 9 weeks later, it had gained 8%. It was still up 7% after 18 weeks. More recently, Russia's stealth invasion of Crimea in 2014 caused an initial about 2% drop in stock market. But later, it gained 1.2% after 3 weeks, 4% after 9, and about 6% after 18 weeks. So can I assume that this tendency will be repeated again in 2022? I may hope so, but there is also another scenario. The Ukrainian war can trigger a lasting bear market. The Iraq invasion of Kuwait 32 years ago may help illustrate why. So I found several examples just to illustrate my way of thinking. As you may know, Iraq invaded Kuwait on the 1990 and defeated it within days. Although Kuwait's population was much smaller than Ukrainians is now, its invasion by Saddam Hussein was an affront to NATO and OPEC countries. And Kuwait didn't rank among the top 10 global energy producers. Yet the S&P 500 dropped 16% and the Nasdaq Composite Index fell 25% as oil rose from $28 to $46 a barrel by mid-October that year. So the current invasion of Ukraine also represents an affront to NATO and geopolitical stability. And it could substantially impact energy markets, as Russia is the third largest producer of energy globally. So all these factors translate into economic uncertainty and market disruption as we saw in 1990. But the Kuwait invasion was met with one of the swiftest military resolutions in history. Coalition forces composed of 35 countries began an air campaign on January 16, 1991, followed by a massive ground campaign, and Kuwait was liberated on February 26, only about 6 months after being invaded. Within the Ukraine invasion, however, the path to a quick resolution appears elusive, if not improbable. Rather than achieving de-escalation through collective sanctions imposed by international coalition that I'm really happy with, the declaration of economic war against Russia, as French Finance Minister Bruno Le Maire has described, it may result in economic backlash against the West. So let's be honest. And instead of the markets bottoming out in 70 days and then rallying as they did after the invasion of Kuwait, investors might need to expect months or even years of challenges to geopolitical stability and some kind of market sentiment. And what is important, for the past 13 years, the Federal Reserve has helped bolster markets against declines. But due to high inflation, which may be further exacerbated by war-related pressures on energy and commodities, the Fed is about to begin a period of tightening. What will be next and how Ukrainian war affects the market depends largely on several factors. So the first is how war will influence the European economy, as there are many interconnections between the economies of combatants and other nations of Europe. That could be a drag on the whole global economy. The second factor, what will be the effect on energy markets? As Russia being one of the major oil, gas and coal suppliers to Europe and elsewhere, Germany, for instance, has moved to suspend the certification of Nord Stream 2 gas pipeline from Russia, and there could be a lot of different other consequences. The third key factor is how Fed will react on this situation. Any plans to aggressively raise the federal funds rate are likely off the table, not to mention suggestions of a quarter-point hike this month. And the fourth factor in today's crisis is the involvement of a nuclear superpower as a part of this aggression. Putin has threatened to retaliate against any countries who will be involved in this war. Could that include the use of nuclear weapons? Nobody knows. I hope no. And perhaps the closest historical comparison, this is a Cuban Missile Crisis of October 1962, when the US and USSR engaged in a stay-down over ballistic missile deployments in Cuba and Turkey. The fear of nuclear war was very real at the time. I remember my father told me about this. And you know, all this story with the dark and covered drills and regular classroom feature, and the novel failsafe about the accidental dropping of US nuclear bomb on Moscow. So how did market react? The Dow's initial reaction in that moment to the crisis was only 1.1 gain, which nevertheless represented a slowing down, a raging bull market that followed the recession of 1960-1961. 3 weeks later, the Dow rose 12%. It would continue soaring up 25% in 9 weeks and 30% in 18 weeks. I hope this information will be a little bit helpful for you to make right decision and to answer the question what you can expect, what I can expect in this period of turbulence and war. Stay safe, and I wish you a peace.